Glad to see that we are getting the room packed up. Hope you had a great lunch. This panel is about strategic capital allocation, how CEOs, board members, and advisors allocate capital to grow and drive the value in ETA-acquired businesses. Our moderator today is Duprey. He developed the concept of nationwide focused financial search fund acquisitions and has been working in the search fund community for nearly a decade. In that time, he has financed acquisitions over 75 businesses, driving over 350 million in loans. So continues to foster long-term relationships with searchers, CEOs, and their investors long after completing the transaction. He prides himself in providing support as they grow and expand their businesses to help achieve ideal results in operating and growing businesses. And Zach is also a frequent presenter at annual ETA conferences and events that bring together the search fund community. So with that, I'll leave it to the panel. Thank you.
Thank you, Tomas. I'd like to start by just introducing our panel, and I'll have them give a brief intro before we get started. We'll start with Brian at the end.
I didn't realize I was going to be first. Thanks. So I'm Brian Axelrad. I'm a partner at HMB Legal. We're based here in Chicago. We've worked in search for about 15 years, and I personally have been in search for about a decade as well as Zach. We see each other on this conference circuit from time to time, and happy to be here.
Hey guys, I'm Saxena. I searched first with acquiring a street sweeping company. As CEO of that, we did a mini roll-up in that space, sold in 2022, and then started another roll-up in the solar space. That's called Mars Energy Group.
Hi everybody, happy to be here. Thanks for joining us. My name is Gabe Barkley. I'm a booth 16, as you can see. I searched with Next Gen Growth Partners, acquired in 2017, a beverage alcohol distribution and import company, exited in 2022, and now focuses on control buyouts in the lower middle market, family and founder-owned businesses.
Thank you. So I'd like to frame up our conversation today on capital allocation and maybe start by talking about Will Thorndike, an early and prolific investor in the search fund asset class. And he wrote the book, The Outsiders. And in The Outsiders, he spoke about choices CEOs have related to capital allocation. And deploying capital includes investing in existing operations, acquiring other businesses, issuing dividends, paying down debt, and repurchasing stock. And the alternatives for raising it in terms of cash flow, issuing debt, or raising equity. So to start today's conversation, we're going to hear from both Gabe and Manny, who successfully acquired, operated, and exited their businesses. And then we'll dive deeper into some of their stories and experiences as it relates to the capital allocation strategy, the decision-making process, and the impacts those had on the organization. Gabe, do you want to get started?
Sure, yeah, so I'll give a little bit of a deeper background on the business that we acquired and that I ran for 5 years with NextGen. So as I said, I started searching in 2016. We acquired MHW, which is a back office services and import distribution company in the beverage alcohol space. What we focused on was enabling brands to go to market in the United States in a compliant fashion more efficiently. We worked with everybody from brand new startups in the space up through large established players. Macallan and Jägermeister are two examples of clients that we had in that kind of latter category. And then, so I guess we bought the business in 2017, and we really pursued several of the options that were outlined earlier in terms of strategic capital allocation. We really focused on areas that we knew would be impactful for the business that we could get board support on, and so I'll just frame a couple of those for you as context for the rest of the discussion. The primary areas that we thought about, which are a little bit different than outlined, were people, technology, which are both ongoing investments in the business, M&A, and then dividends. And so we were able to pursue each of those during our whole period of the business. The people component started with really building the team that we knew we needed to have to bring the business to the next level. That started with a CFO within the first year of owning the business, sales and marketing team in that same year, really to bolster our opportunity for organic growth. We ended up later adding a COO, Chief Information Officer on the technology side, as well as building out a customer experience capability on the team. All those investments were with an eye toward the value creation that they could bring within the organic business. We were able to see some early growth and do a dividend early on, and we had to evaluate that against other uses of capital, which I think we'll get into later, so I won't go into detail there, but that's a decision that we made really in the interest of the broader shareholder set and what we thought we could do with the cash at the time. We also pursued M&A through multiple avenues as we owned the business. One was an expansion strategy, so we bought a company that added to our capabilities, a fully new set of product or service that we could sell. And then we also rolled up a couple of our competitors during the 5 years that we owned the business. And then, from a technology standpoint, I think one of the opportunities we saw, and I think this is similar in a lot of businesses, is there was an underutilization of technology in the business. And so when we bought the business, we were less than a month away from going live on a highly customized ERP system that was 5 years in development. So when we bought the business, we knew that was a risk. We came into the business and evaluated that, decided to move forward anyway, right, with a system that we didn't know would be a long-term fit, but needed to be moved forward with to de-risk us from the old system. But immediately after that, we had to start thinking about the long-term best interests of the business, and eventually embarked on our own second ERP implementation while we owned the business. And so we, alongside all of those things, saw some nice growth in the business, and were able to move into an exit in 2022. And I'll pass it over to Manny.
Hey guys, so we bought a company in the street sweeping space in 2020, late 2020, and for a lot of people who were already thinking about the diligence piece, yes, it had high capex in it. Each truck was $250,000, $300,000. So capital became a really important topic as we were going through diligence, as we were planning our strategies for growth. And we dug really deep into that. I think there's a few interesting nuggets that we can share there, but right at the outset, we were prepared to go in with a capital stack that's going to allow us the most flexibility. That included lower leverage to begin with, but also we had a line of credit. Of course, we had a line of equipment. We also had a line for M&A. And we were able to do that right at the outset because we had both the senior lender and a mezz fund, with the mezz fund being a big equity contributor as well, which basically allowed us to kind of grow the way we wanted to grow. We'll talk about some strategies there today, but it also helped us with M&A and quick M&A. It also helped us with buying assets which were on bid lists, where we had to make a decision on spending $800,000, $900,000, in 5 minutes. How we went about all that. It also helped us kind of think through various decisions in terms of investing in CapEx and what kind of CapEx was it, right? So if you invest in a CapEx in a machine, a manufacturing setup, you kind of buy a machine and you're stuck with it. Whereas if you bought a truck, this was such a liquid asset that you could actually sell it the next day. So the risk of spending that money wasn't as high. Most of the CapEx we spent was after we had won a contract, so there was an associated revenue with it as well. So there's a lot of nuances to CapEx, which I feel like, right, if you look at from the top, it kind of looks a little bit weird, wonky, but it actually ended up becoming our moat because in California, this was where the business was bought. We were able to. They had a lot of regulations which supported new CapEx, so new trucks, which allowed us to be. A winner in that space. Just to give you a background on the business, these are big street sweeping trucks where, they come sweep the streets of a city municipality. We had 70% of the market in Northern California. Biggest customers were Palo Alto, all the big cities that you can imagine. And we pursued a roll-up strategy where we bought 3 companies in total. And we sold it with a very short hold period of about 18 months, and had a really good outcome for everyone involved. So there's a lot of stuff you can talk there, but then we exited in 2022 early, and then I started another holding company called Mars Energy Group. So we're buying commercial solar companies. Talking about here in the business, it's not your traditional search company that typically people buy, but again, diving a little bit deeper, understanding various value metrics made me confident enough to get into it. So we bought a platform company. It's called NewGen Energy. In December, they focus on commercial solar plants in Northern California, specifically focused towards farmers. There's a lot of macro trends, some of which I'm sure you guys already know, but again, nuances there. And then in the last 9 months, we've acquired 3 other businesses in the solar space. And we're hoping to close the 4th one in December. So a lot of playing around with capital for M&A. It could be interesting to talk here.
Excellent, guys. Thank you both. In both cases, it sounds like many of these post-acquisition concepts started with deal characteristics pre-acquisition. What are the cash flow characteristics going in? Does that support the initial growth investments you're about to make? What's the profile of business and what will need to be invested in? In both your cases, it sounds like you had a thesis on value creation. Was that correct, or did your capital allocation decisions change once you got in? Manny, you want to start?
I think for the most part, it was correct, because we really looked at the biggest capital suck for us in the sweeping business were these trucks. And the way we looked at CapEx was really maintenance CapEx and growth CapEx. So the way we valued the business was more based on a free cash flow metrics, not EBITDA, which a lot of times you make mistakes. And the way you do that is you do EBITDA minus maintenance CapEx, and then you allocate growth CapEx as more of a growth metrics. So there were various regulations where we had to upgrade the fleet. So we went deep, truck by truck, figuring out what's the life of each of these assets, and then really dug deep into our capital needs for each of the next 3 years. We shared that with our senior lender. We shared that with our mezz fund, who were all on board right before we started. What was not planned was, Warburg Pincus, a small private equity fund you guys might have heard of, bought our biggest competitor 2 months into running the business, which was you have your oh shit moments. That was mine 2 months into it. But then that made us get into acquisitions pretty heavily. That was not planned, but the purchase price that we went in at, the way we had thought about CapEx, the flexibility we had around that allowed us to pursue that M&A as well.
And Gabe, how about you?
Yeah, so our thesis going in was around a couple of key variables. One was that organic growth was an opportunity for this business. So when we bought MHW, there was no sales function in the business. There wasn't a lot of effort being put into new business generation. We felt like that was a gas pedal we could push down a little bit. And so, as I mentioned, one of the early things that we did was build a sales team, and that one ended up working out pretty well. Another area where we saw some opportunity was M&A. We were in a pretty niche part of the beverage alcohol ecosystem. The service provider importer, there were less than 10 players in that space, and certainly less than 10 of any meaningful size. And there were 2 big players. MHW was a leader. There was one significant competitor, and then a few smaller businesses. So one of our theses was we could roll up a couple of those smaller players to add value, enter segments where we weren't as strong through those acquisitions. And we were able to successfully achieve that in the second half of our hold period primarily. And then one area where we thought that there was opportunity, but we'd never really quite achieved it in the way that we had set out, was operational efficiency. We felt like we could drive better operating leverage in the business. We did incrementally improve that over the period of time, but never to the extent that we kind of envisioned we might be able to. One area we hadn't really considered that we did pursue and see a little bit of success was actually greenfielding some new services. So when we bought the business, it was a US-focused business, and we were a wholesaler in 3 markets, and wholesaler in beverage alcohol can sell directly to restaurants and retailers. A wholesaler has privileges that an importer does not. An importer can only sell to other wholesalers. So we got a wholesale license in another state of Florida. It's a high population, high volume state. And we also opened up an operation in Europe that allowed us to solve a problem for brands trying to go to market in Europe, where we saw some nice traction and growth. Alongside that, we saw an opportunity outside of our core service to support brand innovation. And so we worked primarily with one of the Fortune 500 beverage alcohol companies to pilot and launch a service that we then later scaled where we would increase and improve the cycle time to bring a new brand to market. And so those kind of greenfielding opportunities were not part of our thesis, but they were definitely part of our decision-making within the business in terms of how we thought about capital allocation. And some of that was people's time, not true dollars into those decisions, which I think is a really important part of the discussion that we can talk more about.
And why didn't you achieve the operating efficiencies you expected to? Was it technology? Was it the industry? What was causing that?
Yeah, I think it's two things. One was technology. We had a system that we walked into that was challenging, and then we had a very challenging ERP implementation when we tried to replace it. And second is change is really hard, right? So we had a team that were very good at what they did. They had been with the business for a long time, and as a leader of a business, you have to choose how people spend their time, and you can only choose so many things. So we had to, over time, really choose what the priorities were. Sometimes when you put too much on people's plate, not anything gets done to the extent that you want it to. And sometimes chasing the growth with a strong margin, which our business already had a really strong EBITDA margin. We were in the 35-40% depending on the year. So those operational efficiencies were a little less important for us to focus on than the top line growth, which we felt like would add more value longer term.
Great. And so when you guys are making these decisions around capital allocation, I imagine it's a thesis you guys have maybe with the team, but how do those discussions go at the board level? Are you guys bringing the highest ROI item to the board to suggest where you should go with it, or was it collaborative to get there? Manny, why don't you kind of talk about how you guys did that?
I can start with one example there. So when we bought the company, it was a street sweeping company. There were a lot of old trucks, right? And these trucks were expensive to maintain. And we went in we figured out we were spending a lot of maintenance repair expenses per truck. That was really high. So what's happening was your EBITDA was much lower because of the expenses you were having. But then if you followed a strategy where if you sold those trucks off and you bought new trucks, which would be obviously a huge expense, but then our maintenance expense would go down, whereas your depreciation would go up. So on an EBITDA basis, your EBITDA would be much higher, right? And that was like a little bit of a tough discussion with the board, because at the end of the day, all you were doing was improving the EBITDA. There was not inherently something happening or changing in the business. Of course, there were qualitative aspects of things where the driver would like to drive a nicer truck, and the mechanic would not like to go on a sixth run for a truck breakdown in the middle of a freeway. But we really leaned into it hard because we had the capital was pretty cheap for us, at least back then. And realized that would be one way or the other be reflected in calculations by a potential buyer. So I thought that was a pretty interesting discussion, and we had to go back and forth on, because it was we went in and we were just like, okay, I got to spend $1.5 million. We're just replacing all these old trucks. We're getting in new trucks, and I think my math makes sense, and we had to go back and forth on that a little bit. But really, really quantifying both the quantitative and qualitative aspects of that move was what allowed us to, do that with the, convince the board to go in that direction. And I didn't plan this, but it really helped out because our EBITDA had a lift of about like 14% or something, which is pretty material, I would say. And that was factored in the purchase price when the buyer came in. So that was one, and then the other one was there were these you had to go through like bids on like you said on eBay, waiting for the bid to go down, 5 seconds left, and you got a bid for this equipment. So you didn't have the time to call the board for when you had to spend $500,000, right? So we had to come up with a very tight process with guardrails around how and when can we invest, how much, what type of trucks, what years of that truck it was, and we had an entire board session on figuring out that process. There was a small committee made. I could call one person and make sure that was quote-unquote board approved. I had X million dollars for each year outlined. We knew we had to replace a certain amount of assets, both for the strategy that I was talking about earlier, getting newer trucks, but also regulatory changes we had to buy new trucks. So we really spent a lot of time in building that process. And I think, that's kudos to the board that they were able to, trust a young CEO to make those big decisions, because this was part and parcel of the business, right? It was not like I was trying to go, open up a new office in a new geography, which I had no idea about. It's the business we were in. So that took some time, and the mutual trust between the board and the CEO, I think, goes a long way. People don't give it nearly as much credit, but definitely worked in our favor.
All right, and Gabe, I don't get the sense that you need to work with a 5-second countdown on eBay, but how did your dialogue with the board go, and what was that
My
like?
dynamic was a little bit less time sensitive. I think maybe at a high level, I think there's capital allocation decisions where the board needs to be or should be involved, and then there's capital allocation decisions that you need to make within the business as the CEO. And I think one of the important things is being able to distinguish those and be able to move forward with the ones that you should just be making with your team, and building conviction and building a case around them, because you want to be able to have a strong decision-making process, but you may not need to bring your board into those. And then there's the decisions you need to make with your board. And I think ultimately that should be a more rigorous version of the decisions that you're making yourself. And in my experience, those decisions are not typically made in 5 seconds, right? Manny talked about it took a long time to get that process built in a rigorous process. I think where I had the most success were the conversations that were not a single board conversation, right? They were calls with individual board members. They were maybe even multiple board meeting conversations about large investments, building the framework and the groundwork and the conviction around a decision such that you're able to move forward, everybody's on board, and you have good rationale behind the decision, because they're not all going to go right? And having that strong support structure and kind of conviction behind a decision will both bolster you when it goes well, but it also helps you understand where things didn't go well. If it goes poorly, you can look back on it, learn from it, and do it better moving forward. So a couple examples of that for us. One was early, about a year into our hold period, we had an opportunity to do two things at once. We had an opportunity to return some capital to investors and acquire a smaller business in an ancillary space. That was a conversation that took multiple board meetings, and it took a number of conversations outside of the context of the board as well, because we were weighing multiple things. What does longer term cost of capital for the business look like if we recapitalize part of the business? Is this an acquisition that we should be doing? And is the best use of the cash, if we're adding debt to the balance sheet, is the best use of that extra cash to dividend it out to investors? Right? And so that really became a conversation on a multifaceted array of kind of factors. And communication and understanding of what the alternatives were was key to getting to the right place there. And I think we got to a really productive place, both for me as the searcher, for investors, and for our lending partners, who only a year into an acquisition might view that with a little bit of skepticism, right? If you want to dividend out some cash to, and Zach can probably comment on that, right? It would certainly cause some questions that you want to answer. So communication was key there. And then second, I've mentioned the ERP implementation that we effectively bought into. We knew that was a risk going in. What we didn't know was how it would turn out. And so really for about the first 18 months after we went live on the ERP that was in process when we bought the business, it was a pretty consistent topic where I was trying to keep people posted on what was the status of that system, that implementation, how were things going, did I feel like we were in the right spot or not. And that was an example of a situation where the board also guided me away from my first reaction, which was we could have spent another 6 figures on the system that we had just implemented to improve some of the functionality, to add some capabilities, and that was where I went first, right? The opportunity to really bolster what we already had felt like a lower risk proposition. And the board challenged me on that, really to say, does this system really have the capability, as we think 5 years, 10 years down the road, to carry the business forward into where we need to be? And as we started to have that conversation, it really became clear that it probably wasn't that system. So then the question was, do we implement a new system now or wait? We were about 2 years into the hold period at that point, and so we decided to move forward with a process of adding a technology leader, finding a new system, and implementing it. And having those conversations with the board also helped me have conversations with them when things were not going so well on that implementation, right? We could look back on some of those things, the rationale for doing it, the mistakes that were made, learn from them, and move forward in a productive way, which was a great thing for me to be able to lean on and great for them to be able to have the patience to get through that process, right? But we ended up in a good place, and it largely, again, came down to communication.
Excellent. Those are great stories about how you guys interacted with the board. And I want to kick it to Brian. So you're a board observer on a lot of acquired companies. What do you see across your portfolio that might be similar or different from Manny and Gabe's experiences?
Yeah, I think Manny and Gabe's experiences are emblematic of when my CEO clients are doing things the right way. A lot of what you heard was about priorities, process, decision making. As the lawyer, we get involved in a variety of ways, right? Some are the obvious. If there's things going on that need to be negotiated, if there's paperwork to do, obviously call the lawyer. Sometimes, I guess, not always. But I have some clients that say, look, you have to be in every meeting because you have to understand the dynamic. Because sometimes things are going to happen where, I'm trying to get something that's totally obvious to me and my board's not going to say, okay. I mean, Manny talked about just some of the difficult conversations he had with his board members. And having someone who's a phone call away to pick up the phone as a sounding board to say, I don't know what's going on. I can't get these guys on board with what I'm trying to do. What are you seeing? What are you hearing? I have, and then as Gabe said, I have other CEOs who are like, you just have to be in the room every time because when things don't go well, I'm going to need your feedback. When things are going fine, you can just be a fly on the wall. So I get to sort of be kind of that wide angle lens that can always provide input. I got an email from a CEO yesterday. Conversation came up about doing secondary and having some of the long-standing investors recapped out. He has no idea what that means, but his investor brought it up, and so he calls me afterwards. He's like, Eddie's talking about recapping some of the long-standing investors. What does that mean? How should I think about it? In the moment, he didn't want to raise his hand and be like, I don't know what that means. He just, for whatever reason, didn't want to take the conversation in that direction, but he had me available afterwards. But these are all about how are you allocating your time as an operator, right? And then, as part of the overall process, I will say, as a takeaway, I agree, you shouldn't be necessarily buying $500,000 equipment on eBay at a moment's notice. But as the business gets bigger, right, that $500,000 spend might be in the budget, right? And so one of the things you do in the budgeting process is you go through kind of thinking about what it looks like, and sometimes things are to plan, right? And then you have quarterly board meetings, and you may do reforecasts. And especially when you think about, one of the things I think Gabe talked about at the beginning was people is an investment of capital, right? It's an investment of resources. Are you going to continue to grow headcount the way you thought? Are you going to shift one head to another group because you realize sales is okay, but IT needs more work, right? And thinking about things from that perspective. So, really thinking about engaging the board in that ongoing constructive dialogue so that the board never shows up and they feel ambushed or blindsided because those conversations typically don't go well. But also one of the things that I prep my clients on is if there's important conversations to have the one-on-ones before the board meeting because board members do have minds of their own as much as maybe we would like them not to sometimes. And you put a couple of board members in a meeting and the conversation goes entirely in the wrong direction from your point of view. But if you have the one-on-one advance, you plant the seeds that you want to have planted, you can steer the conversation. They may not agree with you. They may not sign off on it, but it's going to control the discussion and hopefully go to a more constructive and productive place so that you, as sort of the captain of the ship, can take it in the direction that you want to take it. And from my perspective, this is a practice that I brought from a lot of my private equity and venture-backed clients into the search spaces. I'm always sort of in these meetings on a quarterly basis, just a fly on the wall, but if there's a legal issue, you've got someone who can answer in real time. But one of the things that comes up that kind of pulls all this together is the constituencies involved. There's the board, there's the investors who aren't on the board, there's your lender. I think Manny said in his case, he's got two types of lenders, a mezz lender and a traditional lender. And so thinking about the constituencies involved is always something. So just the same way that you may want to prep your board members in one-on-ones for important conversations, important decisions, and try to guide them to the direction you want, or get really valuable insight that can tweak your thinking and adjust that before the meeting so you can have a more productive conversation. You should also be reaching out to Zach and your lender to make sure that they buy in, because it doesn't matter what your board thinks. If your lender's not on board, you're going to have other problems, right? If it'd be great to dividend out a bunch of money, but the lender's got to sign off on that most likely. And that's where, sometimes people have these conversations and it's like, oh, hey, Brian, can we do that? And it's like, well, here's what it takes, right? And that's the more technical answer, but then you leverage the technical answer into the more sort of people, process, priority, constituency-based conversation that hopefully is going to get you to the right result down the road.
Thanks, Brian. And Gabe and Manny, when you guys are looking towards these investments, is it highest ROI first? Is it for laying a better long-term framework or groundwork for the company? Did you individually have sort of a driving, underlying, focus when you were coming up with the message to the board as to where to allocate the capital, regardless if they agreed or disagreed with you? Like, what was underpinning your decisions and which way to go?
Nice soundtrack. I'll jump in, and I'll actually, if I could, I'm going to give one more example on the prior question as well, because I think it's easy for us to sit up here and talk about the things that went well, right? And then there's also the things that we didn't do well. And so I can talk about communication being important. It doesn't mean I was always a great communicator. And one example of that, right, we're about maybe 9 months in to the hold period. We're some middle of 2018. And I talked about earlier how we didn't quite see the operational efficiency gains that we wanted to see in the business. And what I noticed, being in the business for 9 months, is almost everything ran through email. We were answering all client inquiries via email. We had these really complicated team inboxes where our teams were trying to allocate things, and things would get missed, and those were the fires that I or somebody on the executive team had to go put out. And this was a pretty consistent process, right? We had great customer experience most of the time, but when you have something that goes wrong, it's a bad experience. And I came into a board meeting pretty cold. I hadn't talked to any of the board members about what I was going to propose, which was a customer, basically a customer ticketing system, right? So I came into that conversation and said, look, I think we need this. I hadn't prepped them at all, and they basically said, why? And if we're just hearing about this now, it must not be that important, right? So that conversation got kind of sidelined a little bit. It didn't go like negative on me, but it definitely didn't go the way that I wanted it to go. Didn't have buy-in from the board to move forward with that. And being less than a year in, I kind of took that a little bit more as a kind of a mandate against it than I should have. And so I let that go for a little bit longer than I should have. I didn't really think to resurface it for the next 18 months. I don't know if it would have risen to the top anyway, right? But one lesson from that is also that if you do come in cold and the conversation does go sideways, don't be afraid to have follow-up conversations with the board about why that happened, what you can do better, and understand where they stand on an issue, because it might not be the way that it went in the board meeting, right? There may be a curiosity that comes out after the fact where there is actually a reason to dig into that idea, right? But it wasn't in that meeting and in that context. So I just wanted to highlight that. I forgot the question.
The ROI. And
yeah, perfect. All right. And then ROI. I think the way that we thought about ROI was really, you have so many opportunities in these businesses to fix things or to pursue growth. And the number one thing that I, again, didn't do well all the time, but tried to grow into was don't fix the things that are not broken. And then really use a thoughtful approach to understand how hard is something to capture and how valuable will it be. So you can't just look at what the ROI is. If it's something that is incredibly high ROI, but is going to take you 2 years and $20 million to achieve, maybe it's not the best opportunity. If you've got something that'll deliver half the ROI, that's going to be very easy within 3 months and cost nothing, right? So I think looking at it from kind of a multi-factor standpoint, largely cost and ease of execution, and cost should incorporate time that it's going to take in the business and the amount of change that you're going to push through the business alongside the financial cost of that change. And so that's how I tried to look at things. You have to weigh then business needs and kind of regulatory changes or customer needs within those factors as well, and try to categorize and focus on the things that are going to make the most impact for the business in the short term, but with a long-term orientation, because ultimately I think what we were in it for, and I think what most people in this room are in it for, is creating long-term value for these businesses.
Yeah, and if I could just jump in on that, it underscores something, which is not all of your board members are going to be motivated by ROI. You're going to have some people who come in because they've got industry expertise or some type of sophistication or something else they bring to the table as an outside director potentially. And so they may have zero interest in ROI. They want long-term value to maximize. And that's where developing that relationship, having an idea over time of what are the, the buttons you need to push to get somebody on board versus somebody else. You may have two wildly different perspectives for people that you have to talk to in two entirely different ways to communicate and have things resonate with them. And that's one of those things where it's like you really have to feel out your board members and your other constituencies that you need to go to in order to be able to get ultimately to the results you're trying to manage to. And it's a great question on ROI and how you think about that, but you may find that there's one board member on your team that just doesn't care, right? And that just never resonates. And it may be something entirely different that they care about. Until you figure that out, you're going to be talking another language with them.
Yeah, I agree with a lot of what was said already, but I'm a firm believer that the calculations that you learn in business school, although it might seem mundane, but just if you do them through as you're running the business, gives you unique perspectives. So for example, we almost always did an NPV analysis and payback period analysis, which kind of takes into account what Gabe was talking about. You could have a massive NPV, but then it could be 5 years down the road, and it could suck in $5 million worth of cash. Whereas you could have a much lower NPV and much higher payback period or cash back period, which is like a year or 2 years, may not be making as much money, but that's what you might need in the short term. So we did a lot of that, and I think it's a lot of blocking and tackling. One example that comes to mind at Mars Energy Group, we did go in with an acquisitory mindset that we'll go buy a bunch of companies. There was a regulation change happening in April in California, so we knew there was we're going to have a lot of sales in Q1 that we could coast off of for the next 2 years. We had expected like $10-15 million of sales, but we got $70 million of sales in the first quarter, and this is a negative working capital business. So we got deposits worth $7 million, right? So now we're like, oh, we have this cash, but this cash is allocated for building something next year. Now, how do we make sure that we leverage or utilize this cash? Sure, we're getting 3-4% in a money market account if we put that in, but can we get a better return on investment while not taking a risk? So that was another kind of thing that we went. I guess I'm the board chairman there, so we talked a lot in the board in terms of how best to invest that. And a bank would say don't touch that money, because that's committed for future projects. And if you're an aggressive entrepreneur, you'll be like, we'll find more capital, we'll keep selling, right? So that's a discussion that you kind of have at the board level, but. Through these analyses, you're able to come up with something that kind of meets in the middle or allows you to have a much better return on per risk-adjusted basis, right? So what we did was, out of this whatever $7-8 million of cash we had, we understood that there was a big chunk of that was profit for that milestone, right? So if the first milestone that we got the cash for had cost of, let's say, $4 million. So we had that $3 million that was booked in as profit right at the outset. So we decided to invest that $3 million into growth activities, and not feel bad about taking additional risk because we had the project costs covered. And that's how we were able to buy the first 3 companies, first 2 tuck-on acquisitions without any outside equity. So I think some of these decisions are so like search. The volume of decisions you make in search, right from the eBay thing to buying a company using working capital, is massive, and you gotta and a lot of times the environment outside is pretty unique, right? During sweeping, we had a $90 billion private equity fund trying to buy the same company as you were trying to buy, right? So you can't really simulate that. You can't really, there's no like secret formula to be dealing with that scenario. But that's why it's gotta be more of an art than a science, where you're looking at all these different analyses because it gives you a little bit different perspective. I've always been typically more of an IRR fan because you don't know if you're gonna sell your business in 7-8 years or 2 years. And in search situations, typically cash is king, and that allows you a lot more flexibility. It allows you less sleepless nights. That's pretty great as well. So we've always kind of focused on that. Another example that comes to mind is working capital. And working capital, for some reason, with search entrepreneurs, I've always felt like is we talk 10 times more about the EBITDA of a business than a working capital of a business. We had like 4 million working capital at Sweeping when he went in, because the construction company industry was notorious for paying their AR, over 3-4 months, right? So we just installed, we spent a lot of time building the controls, the systems, the processes. We installed a software called AR Collect that would send automatic emails. And that was a really fast way to generate like $2 million of reduction in $2 million of working capital, right? I feel like the areas where you have high NPV and high payback and low payback period, those are like, those like are an instant win and something you should focus on. But I'll end with this. Obviously everyone gets to important and urgent, but not always do you get time to get to important, not urgent, which sometimes can add to a lot of scalability factors. And we're spending a lot of time in Mars Energy on that, because we're looking to scale to a $100-200 million revenue business. You can keep having those small wins in sales, working capital, acquisitions, but at some point you got to look back at the machine and see where the machine needs help or investment, like setting up an ERP system, having the right C-level executive on your team, having the right partners. All that does take a back end sometimes when you're having these small wins. And I feel like a lot of it should be the board's decision to move the entrepreneur towards that as well. So not answering that question directly, but I feel like it's hard to do that anyways.
No, it's great insight, Manny, and thank you. I think this is really helpful as we talk about deploying capital, but maybe we shift a little bit to sort of how you guys raised it. Both of you did acquisitions in your story. Were they cash flow? Was it debt? Was it new equity raise? Can you tell us a little bit about how you finance future acquisitions?
Sure. I think, we talk about that. I think Manny's point about net working capital is so important. It is a factor. It is a part of purchase price, understanding what it is and what the opportunity is. You're not going to know it perfectly, but having a point of view on it and then testing that point of view can really be beneficial in a lot of these businesses. We had a similar dynamic where we were able to turn working capital from 7 figures positive to negative in the business, which added cash to our balance sheet that gave us room, right? It gave us opportunity. So that was one source of capital. We did not raise any additional equity in the business. I kept my CFO busy. I think we refinanced 4 times in the 5 years, largely around acquisitions and then the recap that I mentioned. But that was also due to our growth as a business and the strength of the business and what a healthy balance sheet could look like with what the cost of capital to add incremental cash to that balance sheet for various uses was. And so, as Manny talked a little bit about kind of risk-adjusted returns, right? So we thought a lot about risk-adjusted returns in that context. For example, in 2020, we refied to add additional cash to our balance sheet. We didn't really know what COVID looked like. We actually didn't have a revolver in place because we were a negative net working capital business that had a lot of cash on the balance sheet just due to our ongoing operational factors. But going through that, adding cash to the balance sheet gave us flexibility and room to make key investments as COVID actually turned in our favor, and we saw some nice growth coming out of 2020 and into 2021, and then to execute on acquisitions in 2021. So, I think we were fortunate to not bring in additional equity, at least from a kind of existing investor standpoint. We've really focused on leveraging the cash flow of the business, net working capital change, and debt.
Yeah, I mean, in Sweeping, we didn't raise any equity either because, one, we were under leveraged to begin with, and that helped. Having a mezz partner helped a lot because the ability for them to take on risks a little bit more, and they were also equity partners, so that helped. But we were also at some point, so being in the search fund ecosystem, you're always trying to raise cash flow-based lending because that's what you learn. And at some point, we started to look at our asset, and we were like, man, we have $20 million worth of assets, and our debt is only $10 million. Like, why can't we just start talking about this a little bit more, which obviously is, not a bad thing for the bank either. So that conversation shift, actually, I think, they didn't tell me this, but that helped with, I'm like, this is the net liquidation value of these trucks. It'll be $12 million. Right now, we are at $10 million total debt. So, literally, if the business went under today, you'll still make your money back, right? So that conversation shift helped a lot, and we were able to raise a leverage more than what we went in with. But in Mars Energy, I talked about the story about using working capital, part of the working capital for growth, that we created in the first 10 months of running this strategy. But depending on what your goals are, right, it can't, especially in this environment, debt is obviously the cheaper metric, or cheaper source of capital for you in the long run versus raising equity. But that's also in some ways, if you look at it deeply, it's not the most strategic if you want to grow to a much bigger company. It may not be the most strategic at all times. What allows us, especially during this time where debt is so expensive, I feel like building your cap table when you don't need money is the best time to be raising equity money. And having a mix of investors, it has the option value to allow you to take down a bigger acquisition down the road, which you would not have if you were, you had a short cap table, people's check sizes were limited, and then you're suddenly like, oh, I got to find a big private equity fund to buy this company. The other thing I feel like, if you're trying to go to that scale, we're about, 50 million revenue now. We want to get to, let's say, 250 million revenue in the next 3 to 5 years. At some point, you would need institutional capital, right? And the economics are different, and the way the institutional capital participates with you is different. So you got to the way I look at it is like you got to play in the search fund space as long as possible, because you kind of know each other, you kind of know the search ecosystem well, and the economics are pretty standard. So you want to do that as long as possible until you become a company where you can go to a $250 million, $500 million private equity fund and be like, hey, I want to raise $80 million equity for the next stage. Again, it goes back to that important and urgent and important and not urgent. So I think there's some optional value that folks sometimes look over when they're trying to not dilute. That I'm experiencing a lot in Mars Energy right now.
Yeah, and I'll just I was going to say, one of the things to take away from both what Manny and Gabe are saying is how important it is to be nimble with how you think about capital, sources of capital, and the objectives for the business. Because in my experience, it's really easy as an operator to get tunnel vision on, okay, I got debt, I'm going to do debt. I've got equity, I'm going to do equity. And to be able to think about what type of capital is out there and why, right? Am I trying to scale for growth? Am I trying to refi, right? Everybody always knows business school, right? 101, equity is more expensive than debt, but you forget that, right? It's just like, okay, well, I've got investors, they'll write a check, right? We have some searchers who have committed capital facilities where it's literally written into the documents, they can pull it down if they want it, but that's their instinct. Okay, well, the money's there, I'm gonna go get it. But maybe that doesn't make sense and maybe they can do more with the debt piece of it, and maybe that makes more sense. So it's really great to hear them talk about, being nimble across different types of capital, the sources, the needs, the uses, because it's easy to get tunnel vision.
And then, Manny and Gabe, did you guys have to manage equity incentives across the multiple acquisitions, either with the seller or restructuring of how the equity worked in your deals?
With Mars Energy, we are bringing in sellers who are continuing on with our holding companies. So we've kept it simple because I felt like having conversations around classes of shares and this and that, especially with unsophisticated sellers, is hard. So everyone rolls in at the Mars Energy level, including the investors, the exact same equity type, and I feel like that helps in building trust. And in an industry where it's only 15, 20 years old, the solar industry, so most of these guys are in their 40s or 50s who've done a pretty good job so far, and they have that energy or that gas in the tank to take it to the next level. I felt like you have to be, it can't take 15 minutes to explain where your money is going when you roll your equity, right? And that's how we've kept it. And maybe as we grow, as we have different factions, like, we're buying a company in Kansas now, maybe for each of those divisions, we might need separate equity pools for individual employees there, but we have not gotten to that state. So for now, I've just kept it pretty simple because it's easy to do. All our C-level executives have equity. That was kind of how we started. I feel like that adds an incredible amount of ownership from the employees. A lot of times you're giving equity to people who already feel that they have ownership, but I feel like it's the right thing to do, both morally but also financially in long term.
Yeah, so I had in our experience, a similar approach to what Manny just outlined. We did not have a situation where we had kind of individual equity roles at sub-entities or anything like that. We rolled everyone into the same operating company ownership. And I think that helps to align incentives. There was a time in our first acquisition where we considered the seller's role being into their entity because it had a new service for us. And we thought that, there is a balance between incenting them to grow that service. The risk, though, is growing that service might not end up being what's best for the overall business. So we actually opted away from that to align incentives so that everyone was on the same page, which I think was important and continues to be important. I think where I have not had this experience yet, but we're getting kind of, it's more top of mind for me, and I'll highlight it because I know multiple search kind of vehicles and long-term holds are becoming more prevalent. I think where I think about managing equity incentives is when you have different investor bases behind different assets, and that may only matter on the edges, right? You may only have a 5% different cap table between company A and company B, but that 5% will matter if company A is doing really well and company B is doing really poorly. And how do you think about doing your best by the investors of both of those groups when 95% are the same, but the 5% care very deeply about where you spend your time, how you spend your time, and what effort you put in? And I think ultimately that is, it's a trust building exercise, and it's a communication exercise to make sure that you're able to balance your time if you're in that situation and have a good kind of flow of communication with those investors, because that is something that you need to manage very carefully.
And Brian, across your practice, what have you seen that differs from sort of what Manny and Gabe have done, which is similar?
Yeah, as the lawyer, I say keep it simple, please. I don't need the extra work. No, but I think that's right. I mean, at the holding company level is where you're going to want to see the action. I think that's right, and it aligns incentives. You do see some situations where you're going to have different constituencies and different ownership structures. Sometimes we'll see people who do add-on acquisitions, and they'll try to proportionally dole out it's more mental accounting than anything else, but say, okay, the overall equity incentive plan calls for this. We think this represents this amount of the value. We think this amount represents this amount of value, so we're going to portion this way sort of in our mental accounting, but if we go over one or the other, it's just how do we justify it to the next one when we tell the seller in the next deal, okay, we're setting this much aside. And then also, by the way, there's a dilutive effect if you're going to increase the pool overall because you're doing more acquisitions and then maybe you've used up too much of the pool. How does that work? So there's a lot of considerations. I'm always advocating to keep it simple. There are real considerations that may make it more complicated, but I definitely want to touch on like bringing people in at the subsidiary level is just don't do it. There are some industries where you have to do it. In particular, there's some models out there, and if people are familiar with like the MSO, DSO, VSO space, there are some really interesting models that the private equity firms that are really dominating that space have done, where they can bring people in, and for those of you who aren't familiar, that's in the healthcare space where you bring like friendly physicians into the structure. And those are really complicated, and I had to go to lunch with an investment banker who specializes in that space to give me, the lawyer, the 411 on like, please explain it to me, and like I'm a 5-year-old. So it's there, like people do it, but if you can keep it simple, one of the most important things to keep in mind with equity incentives is like the high level, like this is to give people ownership, it's to align incentives, don't overcomplicate it. You want people to get a piece of paper and feel good that they've got a vested stake, not technically vested necessarily, but like in theory if they stay, but a stake in the business so that if they do well, if the business does well, everybody's gonna get a payout, and the more complexity you put into that, and we've seen all the complexity you can think of, that's not a challenge, by the way. But like the more complexity you introduce to it, the harder it is to sell the message, which is they're getting something that's valuable to them and you want them to be happy about it.
Thanks, and this is a really good conversation. I think we had a lot more planned, but we'd like to open it up the last 5 minutes to Q&A. We have a microphone in the back, so if you have a question, please raise your hand and they'll bring you the microphone.
Otherwise, Zach is going to sing for us.
Hi, the question that I had is with respect to capital allocation decisions. We've talked about people, technology, et cetera. There's certain benchmarks that get tossed around in different conversations as to, with this industry, I want to benchmark X amount of capital allocation to X priority, let's say, 10% to marketing, whatever the case may be. How much does the benchmarking within industries play into your decisions, or is it really more of the conversations that we've had so far? It's just something we haven't touched on and wanted to get your thoughts on.
I would say none, because
Agreed.
Because one, where is that benchmark coming from? Where what size of company we're talking about? What environment? What stage of the company you're at? What's your capital stack look like? The only benchmark you can look at is the performance of your business in the past. That's the only benchmark you can look at. You can do calculations around that, return on invested capital across, let's say, assets, across marketing, across other streams, but not really. There are other loose benchmarks like, hey, the leverage is typically between 1.5 times to 3 times for banks, and these are the typical covenants. It helps you kind of work on your credit agreement a little bit. Think about structuring deals. There are benchmarks like, not benchmarks, but industry understood practices like the senior doesn't allow your seller note to amortize before they do, things of that nature. But I don't know if it's running the business. There are a ton of benchmarks that you look at.
Yeah. Just to add to that, I think that's where your board and your investors can really be supportive of the decisions that you make. Each business, especially in search, is going to have unique constraints, whether those are debt or industry niche or people, and it's going to have unique opportunities. And evaluating those constraints and those opportunities to make the best decisions about what to do with your capital is what's going to be important. Having board members who have seen things done in similar sized companies, maybe in similar industries, and or can just guide you to ask really good questions and challenge you and help you be curious about those decisions is going to be, in my experience, more helpful than looking at industry benchmarks that may or may not be well correlated to the specific company that you're running. Especially because so many of these businesses, they're in niches, right? You could look at MHW as an alcohol distributor, but we really don't have any of the characteristics of the large alcohol distributors in the country, and so we really have to look at the business through the lens of what we know about it, which is both its similarities and its differences with what might exist as a benchmark.
And I'll come at it from a slightly different perspective, but I want to call something out. So if Manny's on your board, don't bring him industry benchmarks and bring him IRR, right? Like that's what you heard from him today. But so that's one thing. The second thing I'd say is I think what Gabe was saying, which is like investors may have a broad portfolio of companies that don't translate closely to one another, which is why they might not necessarily in a meeting say, we see this as the industry benchmark, but as I said before, like my sort of observing on boards comes from practice I brought from like private equity and venture capital more traditionally. So a lot of those businesses have, a lot of those investors have portfolios that are very tied to particular segments, and they will tell you what those industry benchmarks is because it's close of mind. It's like the availability bias, right? Okay, all the companies in my portfolio fit this type of business, and therefore they all spend X amount on marketing. If you're going to do more or less, explain it to me, right? And so part of it is gauging your audience. Do they have that? Because if you're going to tell them to do something that's way outside the norm, and they have the sample size to gauge that, then that's going to be a problem, and you're going to have to overcome that potential obstacle. Versus if it's an investor with a broad portfolio that doesn't necessarily lend itself to comparables to you, then I think it's going to be something like that conversation may just never happen at the board.
I think it can be helpful to know those numbers, right? It can be helpful to be familiar with them. I think what you're hearing is don't necessarily let that guide you in a vacuum, right? Make sure that you're taking into account all of the various information before you make those decisions.
Excellent. Well, with those remarks, we're going to conclude our panel. So we'd like to thank the ETA communities at Kellogg and Booth. And if we could have a round of applause for our panel of Brian, Manny, and Gabe.